What's going on, guys? Brian's here. Today is September 26, 2025. Yesterday, the market bounced at a key level and all of the usual suspects were there. I took the bounce trade off of this level, and this video is a quick review over all of the usual confluences that I look for. I opened a long call broken wing butterfly. I like this structure because my risk to the downside is relatively small. As you guys can see, it was about 190 bucks as I got filled at $1.90. My risk to the upside is a little dangerous, but that's only if the market went really high, and it's still a max loss that I'm more than comfortable with if the trade was held up until Monday. Today is Friday. I closed the trade out earlier today, so I have no risk holding anymore, and that's why I decided to hop on and do this video. I was also relatively comfortable opening up a 43 DTE iron condor on the SPX. I'm showing my actual size here. You guys know in this YouTube channel, I generally try to demonstrate things in terms of one lot, so you guys are not intimidated by how much margin or capital is being used per trade. You can scale up or scale down according to your account size. Lastly, after the market closed yesterday, I opened up a futures bull call spread, and this was just to offer a little bit of protection in case the market had an extreme overnight gap up. I was fairly confident in the market bouncing at 655. Let's start with something very elementary. Even if you know nothing about gamma exposure or option spreads or implied volatility or futures or the RSI, at a basic fundamental level, you should understand some sort of technical analysis or how to read price action. Last week, Wednesday, was the FOMC announcement. What this chart is showing right here is that there was a lot of traders and a lot of activity happening right around this catalyst. This created a key structural level on our chart. So at the very basic level, as a trader, you should have been aware of this area and it should have been marked off on your chart. A trader would consider this entire area some sort of a demand zone. I'm just going to change the color to green. As price held up in this area and it actually pushed to a new all-time high. This is the current all-time high on the SPY, SPX, ES. They are all derivatives of the S&P 500. Yesterday was the first time price returned to this area. So right off of the back, a trader that reads price action or understands how supply and demand works would be aware of this general area. Long-time watchers of this channel know I use gamma exposure. This was a very important gamma exposure level that we were aware of at the start of the week. There was the usual confluence in which I look for in the VIX in terms of the markets formed a double bottom right here to here, but the VIX did not go back up to the high. The VIX actually showed some sort of a divergence, as we can see that the VIX went lower even though the markets went lower. The VIX should have gone higher, but it did not. So this is one sign of confluence for me. The fact that it was a key significant gamma exposure level was something that I knew to be aware of. There was divergence in the RSI with the futures. As we can see, the ES went lower, but the RSI was showing bullish divergence. So we have divergence here. We have divergence between here and here. We established the fact that last week's FOMC created an interest for traders at this area. All of these things combined gave me confidence to be long at this level. I generally start every week doing an analysis of what I expect for the week just based on gamma exposure. This is the information from Quant Trading app. Link is in the description if you'd like to learn more, but I'm pulling the information from Quant Trading app for the week's expiration. So this would be Monday, Tuesday, Wednesday, Thursday, Friday. I get this data, I look at this graph, and then I plot it on my chart. And that's where these levels are coming from. It establishes a range in which I would expect the market to trade in. It also allows me to have expectations for how I would expect price action to trade around these key strikes. That is how days in advance I can anticipate or expect when a key level to break, there's going to be a decent scalp right down to this level. For this week here, I was expecting if 662 broke, we would have a quick scalp down to 660, and that's exactly what we got. So I was just highlighting that for the traders within Quant Trading app. But for the trade specifically for yesterday, I ended up missing the initial bounce as the market opened. So all I said was I was going to be patient and wait for a retracement. I was a little distracted and preoccupied with other positions, so I did not get the ideal entry of the day, but instead of chasing it, I said I missed my entry on the SPY as it bounced at 6555, but if there's a retracement later and I see some confluence, I'd rather take a cheap shot at 663 then take another short trade down to 652. I was prepared for the short early this week. We had early signs of this here. We had a nice technical pattern that was forming. It was forming right around a significant strike. This was the most important strike for the week of 663. Once that level was broke and we saw the momentum kicked in, we had another pattern that was formed. This led to another decent trade. So some traders in QTA are able to capitalize off of this information, as one of them is just asking if it would be more viable to buy this dip. I mentioned that I will wait. So now later in the day, so this is not even 1 hour into the market has opened, I waited well into the afternoon. So here it goes at 2:15, nice volume coming in right at where we expect it to be. So we can see that on the chart right here. If we just pull this back up, look at the volume that's come in. You don't have to try to predict anything. You don't have to make it complicated for yourself. These hammer candles that form at significant levels, this is the confirmation right here. This is telling you there's a lot of activity happening at a significant place on the chart. We're not imagining this. We're not making it up. We're not trying to be fortune tellers. We're not gambling. We are being patient and waiting to see the signs of what we generally will always find whenever the market is setting up to create some sort of a bounce. Early in the day here, there's no real signs or none of the usual suspects that I look for. At a double bottom, now we're talking. We already know to look for the bounce in this area. We just want the signs, and the market is giving us those signs. So here's the volume coming in. Here's the bullish divergence in which I'm talking about that was happening in real time. For members in Quant Trading app, we had the extra confluence of the QTA intraday zone. We had the hammer candle forming on a smaller time frame. This is a 3-minute time frame. The 15-minute time frame is my main time frame for day trading, but for smaller entries or for scalps, the 3-minute is the time frame that I use. We can see the same volume spiking right at this significant area. I seldom say anything is easy or too easy, but this was just so much of a gimme. We had the same thing happen on the SPX. Massive, strong, bullish 15-minute candle that was formed. Some of the extra data within QTA, this was from the Quant Trading app's trade engine that was showing this was the expected move. This was the 1x expected move from the open. That means when the market opened today, based on the options chain, the way Quant Trading app reads this data, it's letting us know this is the expected move for the open, which generally tends to be of support if we see some sort of additional confluence. This happened to be the strike also on the SPX that had the most amount of put volume. So there's a lot of put volume happening here, an extra sign of significance at this strike price. It's the expected move of the open, which generally tends to act as support. We see volume coming in on the chart right here. We see bullish divergence. We see divergence in the VIX that's happening right here. All of these are signs. I love buying the dip. It is my preferred style of trading. I like volatility, but more specifically, I like to short volatility, and I like to be a contrarian whenever the market is selling off. I generally prefer to be long the SPY. So I won't always take the short trade. I'm usually waiting for signs of a reversal for a bounce, because the bounce will always come. We don't know if there will always be a top, because in theory the markets can go up straight for forever. There's nothing to say the market can't go up for 100 days straight in a row. Is that likely to happen? Of course not, but there's nothing to say that it can't happen. In comparison, the market is not going to go straight down to $0. If it did, the world will have much bigger problems than the stock market. It's probably World War III and there's zombies walking around outside. Now 663 was my target for the end of the week. So at this point here, while the market's here, I'm already anticipating us to go here, because at the start of the week, this was the strike that had the highest absolute gamma. It was the G flip strike. It had the highest open interest. It had the highest call open interest. There are a lot of signs here. So this is just too easy at this point. Market's down here. A lot of the data is pointing up here. I see all this confluence here. It means it becomes a no-brainer to take the risk and be long targeting this point. For people that don't like to swing trade, today presented a day 2 possibility, as this was the retracement to the 2-day anchored VWAP. So let's just say you're nervous, you didn't want to swing the trade, even though it had all those signs. You're in Quant Trading app. I shared the signs as it was happening. As you guys know, I opened a broken wing butterfly. I shared the iron condor that I'd opened early in the day. But let's just say all those things, you're still nervous. You still don't want to take the swing trade because you're uncomfortable with risk overnight. Well, this is your opportunity here. It's the following day. The market gaps up. It's showing strength at the open. We get a retracement, which usually happens. The 2-day anchored VWAP is right there. This becomes your entry. This becomes your area in which you can look for additional confluences, maybe on a smaller time frame. This is where something where the Fibonacci's become valuable as price retraced right to the 50% retracement. So this is the momentum move up. This is the 50% retracement. And then you take the bounce back up to the high of day or wherever is the most sensible expected resistance level. This was max pain also here at 662, so it didn't quite make it up to 663, but that didn't matter. As an advanced options trader, I like to create structures in which I have some sort of asymmetrical risk. In other case, even though I had all that confluence and all the conviction, I still opened up a trade that was very limited to the risk to the downside in case something crazy happened overnight. If you're interested in my actual size, I had 2 lots. So my max risk was less than 400 bucks, no matter how low the market went. My max risk to the upside was under 1500 bucks. So it's still not that crazy. And there was plenty room to the upside. Notice I avoided the Friday expiration. I didn't want to go with the 1 DTE because when I trade these type of broken wing butterflies where there is risk to the upside, there is the possibility that the market could have gapped up 1% and then rallied another 1%. It was unlikely, but we never know what the market is going to do. So I still kept my max risk to the upside relatively low, but notice where things get dicey on this trade. It is right around the all-time highs. That is not a coincidence. This is the all-time high up here. This is the gamma exposure profile again for the week. We can see this is where at the highest I would have expected that bounce to go. On the SPX, this is it right here. So about 6,700. 6,700. So take notice of how I structured this trade. If the market was to bounce and rally and continue rallying, I would have expected there to be some sort of resistance along the way. First at this strike right here at 650, and then lastly around 700. However, if the market did break past 700, that's where I figured I might as well just grab a couple of these after the market closed, just for a little bit of insurance and protection in case something crazy did happen. As we can take a look, if the market did bounce up here, that would have been about another 0.8%. So let's just say the market did bounce around 0.8%. This would have made 800 bucks. This would have been relatively flat. Minimal risk here. Same thing if the market did gap down, or let's just say the support broke. Anything past 1% would have meant this would have been well eclipsing the losses that would have been happening on this side here. The market would have had to go up over 2% or something like that. And at this point, we're talking about a full Friday's worth of trading. I would have had plenty opportunity or time to make any type of adjustments, maybe add just some long calls, sell some puts. I could have done anything at this point here. But the purpose of this video is just to show you guys the usual confluence that I look for. Anyone that's been watching this channel for a while, you guys are well aware of the usual things I look for. I've done a video on the RSI divergence. I've done videos on the VIX SPY divergence. I've done videos on this hammer candle with volume. I've done multiple videos on gamma exposure, and I've done a few videos on how I map out and plan the week. This is just showing when all the signs come together, just being patient and waiting to take the trade at the levels you are familiar with can lead to successful tradings. How you choose to execute is completely up to you. I sometimes do things a little too complicated. Another trader might have just bought some futures contracts, or another trader might have just bought some long calls. I like to reduce my theta risk. So with a spread like this, it means, let's just say the market was choppy for a bit, I can still profit, as I don't like the idea of holding a short-term call waiting for the markets to make the move. I was not sure at this point how aggressive the momentum would have been. I wasn't sure if it was going to take not only today but Monday before it made it back up here, and that time decay would have been driving me nuts. So that's why I chose to run that broken wing butterfly as my primary trade to execute on this. My 43 DTE Iron Condor is just an income generating spread. It's relatively safe. It's extremely wide. I just decided to open that mostly because of the spike in the VIX that occurred earlier in the morning, and knowing where we were spiking and coming down into. The Iron Condor was open to be inherently short delta, so if the market went down a little bit more, it would have been okay, as you guys can see here. And if the market does bounce back up to the all-time highs, again, there's room, and that's the point of why we open these types of Iron Condors. And obviously, if the implied volatility was to come down just a little bit, that's going to benefit an Iron Condor such as this one. Guys, if you enjoyed this video, let me know in the comments down below. Like the video, subscribe if you learned something. Thanks for watching, and I'll catch you in the next one.